right, welcome everybody. Thank you for joining us today for the Salesforce Ventures WIC Fortune 100 Lunch and Learn. Please share in the chat where you're joining from. I am from Huntington Beach, California. It rained a little bit this morning and the weather has changed. The sun has come out for the day. Who do we have joining us? Where are you guys from? All right, San Diego, very good, welcome. New York City, love it. Canada, love my Canadians. Germany, very cool. Seattle, Palo Alto, love to see it. Well, thanks for coming, everyone. I'm Erin Northern. I'm the partnership lead for Women in Cloud. I create access for our community to connect with corporate leaders and partners to unlock opportunities. If you're not fully aware, Women in Cloud, we are a community-led economic development organization. We're taking action to generate over $1 billion for our women entrepreneurs and professionals by 2030. And we're doing that through partnerships with corporations, community leaders, and policymakers, all of which are united by ESG and UN Sustainable Development Goals that are driven by job creation, diversity and inclusion, technology innovation, and sustainability, giving women a powerful platform to accelerate as industry leaders. Just one moment, we're having some technical difficulties. We're going to get our slides right, just a few minutes, but I do want to know what's motivated you to join today's webinar. Please share in the chat your answers. So why are you here today? Are you wanting to learn how to invest with Salesforce Ventures? Are you wanting to learn about how to create a really great pitch for yourselves when you are in front of investors? Please share with us. All right, well, I hope everyone's getting excited to hear from our partner Salesforce Ventures on how our entrepreneurs can navigate investments for their solutions. We're going to be hearing from Enki Toto. She's an investor and senior manager with Salesforce Ventures, and she's going to be helping us learn more about the basics of investing and how a corporate VC is different, how to prepare for your pitch, and more, followed by a Q&A with her. So Enki she's an investor for the Salesforce Ventures Impact Fund. It's a corporate venture capital fund that invests in cloud technology solutions, including education and workforce development, sustainability, DE&I, and the social sector. She's been involved in the company's investments with Block Power, Circular, Krahana, Elvest, and Propel. So welcome, Enki. Thank you for joining us today.
Hi, Erin. Thanks for having me, and thanks to everyone that's joining the call. It's great to be able to speak to you all, and again, thanks for joining and listening to what we have to share today. So happy, Erin, to kind of run through the presentation now, if that's helpful.
Oh yes, please, absolutely.
So, just a bit of background maybe on our fund. So I'm one of the investors as Erin mentioned, on the Salesforce Ventures Impact Fund. So our team is really focused on investing similar to Salesforce Ventures and enterprise software companies, but we're particularly looking at companies that have a social and environmental mission. And so for us, we look at financial returns and want those market rate financial returns, but we also dive really deep into impact and look at, what's the impact that the companies are having? How many students are they serving? What are the types of, communities that the students that they're serving are coming from? Are they expanding financial access to those that are previously underbanked or unbanked? Are they able to make substantial strides towards climate action, et cetera? So like I said, we're really looking for that impact. And then in terms of the type of investor that we are, and I think this will make sense as we go through the presentation, but we're typically a follow-on investor. And our check size is anywhere from 2 million to 10 million, but we really are that follow-on investor, which, as I said, will make sense as we go along this presentation. So maybe next slide, thank you. So just an overview of what I wanted to cover today is, one, different types of funding. There's so many sources of funding out there, and I believe really strongly in finding the right type of funding for your business and for your goals. And then we'll do, because I am a venture investor, do kind of an overview of what actually is venture capital. It's definitely been a hot hot topic in the last 2 years as funding has grown and grown, and more capital has been allocated to venture. But I think it'd be helpful to kind of go through the nuts and bolts of venture. And then lastly, would love to cover some pitching tips. We see so many companies on a weekly and annual basis. And so just pulling together some what we like to see in a pitch deck, and what I want to make sure that you all are well equipped to include in your pitch deck, as well as, nuts and bolts on financials and different KPIs that investors are likely to ask. And I'll apologize in advance for my sound and my throat. I'm still recovering from a little bit of an illness, so might have to sneeze once or twice here, but apologies in advance. All right, so if we go to the next slide. Yeah, so this is, as I mentioned, there's so many different types of funding, and it is really, really critical to make sure that your goals on how you want to grow your business and what your goals for the company are and your milestones that you want to reach in 3, 4, 5, 10 years look like, and then attaching those goals to the right type of capital. And so think about capital, and think about the life cycle of a company. There's sort of the early stage. So you have the idea, you're pulling together those first few customers, you're still building out exactly what the product is and how it aligns with your customers and what exactly they're looking for. And in this case, typically you'll look for either debt investors. So you could take out a traditional loan, similar to, working with your local banks. There's certain funders out there that are specifically focused on small businesses. And actually, we are talking about startups. So there's actually a whole wealth of startups out there that are specifically tailored towards underwriting small businesses. And it doesn't necessarily have to be venture debt. So companies that are funding institutions that are investing in companies that then want to get venture debt. There are startups that are investing in any type of small business. And then equity is venture. And so we'll dive much deeper into equity. But then the other one is grants and SAFE. So grants is something interesting, particularly if you are investing in, or you're building a company that is impact related. Over the last couple of years, there have been so many different types of grant organizations that have popped up. And so I think that this is an interesting one to look at, because it could give you that sort of bootstrap money that many co-founders can't necessarily ask their friends and family for. So grants are a great way, and looking into the exact type of, either philanthropic institutions that not only invest in nonprofits, but also are now starting to invest in for-profit companies. I think those are really interesting. There's lots of government grants out there as well, specifically tailored to the SDGs. So I would definitely do your own desk research, but this is a new category of funding that is up and coming. And then, so these are types of capital, but sources of capital, you'll see so many of these. I think many investors, especially angel investors, and I have friends who have started companies, say to look at friends and family. I think while that's great, that's not necessarily an opportunity for everyone. So I think those pitch competitions, crowdfunding, looking at different family offices, and looking at incubators and accelerators, I think these are sort of other opportunities for you to gain funding outside of just bootstrapping or friends and family. And then what we'll spend most of the time today is talk about venture. So if we look at, we can go to the next slides. Perfect. So venture capital is a very unique type of funding. And I want to make one thing clear when we're looking at all these different types. I know that because venture has been so popular in the last couple of years, there's this connotation recently that it's a cheaper type of funding. And I would argue it's actually one of the most expensive types of funding you can get. So what do we mean by venture? Venture is taking a direct ownership into the company. So you are giving up your company ownership. You are now sharing it with investors, and they are, yes, providing you capital upfront. And yes, there is no interest that you have to pay on that capital on an annual basis like you would on a debt loan. But ultimately, when your company exits or decides to sell, at that point, you do have to pay back your investors. And so your investors are the ones that have that preferred ownership in the company, and typically are the ones that are getting liquidated first. So dive into that in a little bit more, but I just want to overview of exactly what is venture and how does that work. So we go to the next slide. So when we think about venture, there's also different types of investors here. And as I mentioned before, I think, while finding the type of capital that's appropriate for your business is important, when you do decide to go after venture debt or venture capital, it's important to know the type of investor that you are ultimately entering into a relationship with. So these are just a couple types. There's many others that will come up, but two that I want to talk about is institutional investors. So these are your typical kind of like Tiger as an institutional investor. Salesforce Ventures actually is a corporate venture, but is starting to act more like an institutional investor. We look at companies or funds like Bessemer, et cetera. So lots of these institutional, they're looking for market rate returns. They have investors and LPs in their own funds that they need to then return back to. So they have very strict timelines around when companies need to exit, when they need to have a return on their investment by, et cetera. And then corporate venture funds, these are typically the venture fund of a company. So Salesforce is a good example of this. We started our venture fund back in 2009, and it was really with a strategic lens. So we started it to build out the Salesforce ecosystem. How do we invest in companies that are building on top of Salesforce, or companies that ultimately could be additive to the Salesforce ecosystem? And so there's lots of different types of corporate CVCs, as they are called. You have ones ranging from, Google Ventures, which has no strategic alliance to Google, right? While Google is their LP, they are not they act more like an institutional fund. And then you have Salesforce Ventures, which is in the middle. We look at more opportunistic strategic opportunities. So how do we partner with the companies down the line? But we're not necessarily, we don't need to have an inked contract in place in order for us to make an investment. And then I'd say the third bucket of corporate venture funds is ones where the only way that they'll invest in a company is if there is a contract. And sometimes entering into that pilot program or that contract is part of the diligence and is part of sort of the fundraising process in engaging with that type of CVC. But it's a very different type of investor than say a more institutional type CVC. So as you're looking at corporate venture funds, I definitely, as we say in interviews when we're hiring, sort of like it's your opportunity to interview the funds as well and learn about them and sort of what their goals are, what their values are, et cetera. And then the fundraising process. So really it starts off with understanding what type of capital you're looking for, but then also how much capital do you need? And then going out and talking to these investors. Fundraising can be a very lengthy process. It can be quick or it can take a long time. It sort of depends on every use case is different. It's based on sort of what's the timing in the market, how busy are investors at the moment, are they going through their own fundraising, et cetera. So I would definitely recommend starting those conversations with investors and getting that list of, who are the investors that I really want to talk to because their mandate matches to what I'm looking to build, right? I'm building the type of company they want to invest in. It ties into the sectors and industries that they are typically investing in. So I think these are the good investors for me to talk to. And then after that, it's, starting to have those conversations and looking for that lead investor and looking for those additional investors to fill out the round. And other things are, figuring out what your valuation is. So part of that is a conversation with your lead investor, but having an idea of exactly how much you want to raise and at what price you're willing to take in this capital is also really important. And then I think we covered this, but some key pointers, again, making sure venture is the right type of capital for you is really critical to the entirety of the venture life cycle. And when you do enter into that relationship with a venture investor, these are relationships that can last up to 10 years or more. And so you really want to make sure that you're building the right cap table there. If we move to the next slide. Perfect. So I'm just going to cover a few slides on different types of investors and where they come in the life cycle and what their value adds are. So as we mentioned, you begin with an idea, and you need that initial capital in order to pay yourself, pay your engineers, pay for the, where you're building this, right? The rent, the maintenance, et cetera. All of these requires cash. And so angel investors are the ones that come in really early when there's an idea, right? Sort of that you have that pitch deck of here's what I want to build. I'm starting to build it, but now I need funding in order to really, and help in order to really build out my business. And so angel investors are uniquely positioned to they get into the details, right? They work on, what's your supply chain needs to be? What tech do you need to build? Let's connect you into the right tech founders and other founders that they have in their ecosystem. Let's connect you to the right talent. They'll go into helping you build, a financial model and really working through the nuts and bolts of what does it take to build a company. So angel investors are invaluable for really getting your company from zero to step two, right? Zero being you have an idea, and getting to that seed or series A phase, these investors are critical, and typically are also really critical in landing those initial early customers because angel investors have their own networks. And then once you're kind of done with the angel investor round, that's when we move on to the next slide. That's when we move on to venture capital more broadly. And so these VC firms invest at, you'll hear these terms, but seed, series A, series B, series C, et cetera. So at seed and series A, you typically have that product, you have that customer, right? Initial couple customers, that product market fit. And now what you need cash for is scale. So how do we get more customers? How do we rapidly grow the company and rapidly become, closer to that unicorn? And so that's where our VCs can be really helpful because they give that influx of capital, and then also they're uniquely positioned. Like I said, angel investors are really working on the nuts and bolts of building the company. Venture investors are really focused on, okay, you got the product. Now, how do we build out a really good sales and marketing strategy, really good go-to-market strategy, building out your executive team to really fill it out? And so that's where venture investors will really push and start looking for is that scale and that rapid growth. And then the last part of the life cycle on the next slide is exit. So these are just two types of exits. There's lots of others, but one is acquisition. So acquisition can come from either a private equity fund buying up a majority. It can come from a strategic acquiring your company. It could be a merger between two startups together. So exit can look very differently for different companies, but exit is also what investors are looking for because they're looking to get that capital back. So when you're exiting, you're typically paying off your investors because someone else is now acquiring that ownership in the company. And then IPO is, we've seen so many IPOs in the last year. I think it's been the hottest market for IPOs in many, many years. But IPO is the other one where instead of selling your ownership in the company to one third party, you're selling it to the public, right? You're now public on the stock exchange. So typically for an IPO, you're looking at a much bigger exit value. So at this point, expected to be in the $1 billion plus category. And at that point, that's where companies start to think, maybe my exit here is IPO versus an acquisition. All right. So that's sort of venture in a nutshell. And then working through kind of the advantages and disadvantages. I mean, there's both, right? On the advantages side, you get capital, and that's invaluable because when you're looking to build that company, when you're looking to hire that sales team and hire a team in general to support you, having that capital and a means to fund that hiring is really important. We've seen in recent times that having certain investors on your cap table is also a way to attract talent. So that's something we've definitely been hearing from companies out there and individuals who are looking to go to a company. And then, if investors they have an interesting perspective on the world, this is their day-to-day job, right? They're constantly looking at companies and are invested in many companies. And so through that, they see what's worked and what hasn't. They can kind of figure out red flags pretty quickly and help advise you on, what they've seen in the past and how it's worked out and what the best path forward could be. So they do have that invaluable expertise. They also have lots of connections. So lots of institutional funds have LPs who are directly invested in their funds. So those could be direct initial customers. They have their own portfolio that could be customers and also a community to relate to. So you build a lot of bonds with those other portfolio companies, as well as potential introductions that you can get from your investors that could be invaluable customers. And then, they have that industry. So there's lots of different types of VCs. One is a more generalist VC. So they'll invest in anything that seems venture backable, where they're looking just for a large market and that big return. And otherwise they're pretty agnostic into the types of companies that they invest in. Or you have a really industry specific venture investor. So Salesforce, for example, is really focused on enterprise software. We know that's where we are best positioned to work with companies and where we can offer the best advice and be the most valuable investor. And so that's why we're always looking at those enterprise software or fintech companies. Other investors, particularly the ones that we work with on the impact fund, are really focused on climate, for example. And so they have a deep expertise in climate tech and know a lot about how to build a great climate company. So I think that different type of experience, having a well-rounded cap table, is also really important. So you get all those different types of experiences and expertise together, and you have different investors to lean on for different things. And then, your lead investor will typically have a board seat. So this is someone that will be in your quarterly meetings and really driving some of the discussions and also the push as to where your company is going. So you get that expertise on a quarterly basis, but you also have to realize that that's a relationship that will stay there for 10 plus years. And then on the negative side, as I mentioned before, you are giving up part of your company. So it's by no means free capital. They are directly, owning your company. It can take a while to raise venture money. So, at the early stages, it can be a little bit quicker just because there's less diligence, but as time goes on, it can definitely take much longer. And then you really need to make sure that the house is sort of in order. So there'll be a lot of diligence, a lot of customer calls that investors will look for. There'll be, financials that be required, KPIs that they'll review, et cetera. So lots of different things that you need to be prepared to provide to investors. All right. And then if we go to the next slide. So we talked a lot about what is venture, what are VCs typically offering, and what's their value add, why you need a VC in your company. But one thing I did want to share is kind of what is this process. I know sometimes it can be kind of behind the curtain and it's not as publicly shared as like what exactly what does it mean to get VC funding? What's that look like? So I think this is very typical for lots of investors, but for us, I know this is the case. It's we're typically having that initial meeting, maybe a follow-up meeting, kind of having those conversations and getting to know investors. It's that two-way interview of you researching them researching you, et cetera. And then once you're ready to start that investment process, so once you get a data room together, once you get all your financials together and all the materials, that's when investors will start doing their diligence. So they're going through, your financials, they're going through your customers, they're looking at how well the company's done over time. They're diving into the product roadmap. They might bring in experts to make sure that they really understand the technology that's being built, et cetera. So this becomes where you really open up the floodgates for questioning, and there's that much deeper review of the company that happens. And then typically investors, once they gather all that information, will pull together a pretty detailed investment memo. So this is what they present to their own investment committee, and that's a term you'll hear often. the investment committee is essentially the team that's dedicated within the fund to make the decision of whether do we invest or not. And so at that investment committee, investors come in with the proposed amount they want to invest, the valuation metrics, who the other investors are that are around the table, and then also the reason behind, all their findings that they've had on the company and the reason behind why they want to invest. Sometimes, the companies come in to present to investors during a partner meeting and an IC committee meeting. So that's something to be mindful of. So this whole process could take multiple rounds of discussions and multiple meetings and lots of back and forth via email. So that's why I say it's definitely not a quick process. And then after that investment committee meeting, it's typically a pass, or you go into term sheet, or if you're a follow-on investor, you go into kind of confirming allocation. And that's when you start having these negotiations around, what are the terms? How do we finalize this? Doing legal diligence, like opening up more and more contracts, et cetera. So, and then after that, you get funding, which is great. And then you do a press release. So that's the typical process. I'd say, it can change by fund. There's funds that can do the process in a month. There's funds or in 2 weeks. There's funds that take a little bit longer because, they need that time. So it really, I'd say there's no clear-cut timeline. And there's also, I don't think there's anything negative around like the timing of what investors. It's really just you looking at, who is the investor you want, and then figuring out what the right timing between you two is. All right, so if we go to the next slide. Perfect. So I said before, there's different types of investors. So I know I mentioned the lead investor, but this is really that anchor investor. So typically you want to get this lead investor first. They're the ones that set the terms of the deal. They're the ones that offer that term sheet, as I mentioned. And the term sheet is essentially a 10-page document that is a pared down version of the key terms that go into your financing docs. So this is where you discuss, what's the pre-money valuation. And as I mentioned before, you really want to make sure that you're having that pre-money valuation like in your head as like how much do I want this company to be valued at. And then investors will come in and they'll do their own calculations around that. And so there'll be some negotiation there. The round size is, how much money do I need to raise? That's why it's important to make sure what you want to raise is in line with what your investors are thinking about as well. And the closing timeline, liquidation preferences, typically this investor is also the biggest check in the round. That's why they're called the lead investor. So they take up a majority of the round. They usually get a seat on the board. And so this lead investor is really important. And then you have follow-on investors. So follow-on investors are essentially filling out that round, right? So lead investor, let's say, and it depends how much they take, but if they take 50% of the round, right, you still have another 50% to fill out. Some of this will be from existing investors and some of this will be from net new investors. And so these are new investors that don't necessarily write, $10 million checks, but could write $1 to $2 million checks. And the reason to have these follow-on investors is, as I mentioned, lots of different types of VCs. You want to have this well-rounded round to have to lean on that different expertise from lots of these different funds. So typically, they also sign on to the term. So they don't get as much pushback on what the valuation is, et cetera. And then strategic investors, these are typically corporate venture funds, but similar to follow-on investors in check size and structure, but these could be where you get some really beneficial commercial arrangements or customer relationships from. All righty, next slide. Okay, so that was, I feel like we're hopefully going through this with enough time. That was sort of the overview on venture and what we're looking for here. But I think just as important is ensuring that you all are well prepared for this type of pitching and conversation with investors. Sorry. So I just wanted to share some pitch deck essentials. If we can hit it again, because I think this slide has like some automation in it. Perfect. So when you think about a pitch deck, the way I always like to talk about it with founders is it's your narrative on your company. So you want it to be it's your resume, right? This is your what you've been working so hard towards, and the pitch deck is your opportunity to highlight that. And so it really needs that, emotional pick me up. So how do I what's punchy about it? What's different? What's the problem here? What's the market opportunity? Why are you uniquely positioned to solve this problem, right? And by you, I mean you as a founder. Why are you the one that's building this amazing next company to solve this huge problem that we have? And then the what. So definitely want to be very clear on how your product directly solves that problem. I think having that be concise and pitchy and really, really streamlined is so important. You think about what's your own elevator pitch for yourself. It's sort of what you want for your company is, here's the problem and here's how we can solve it. And here's why we're different than everyone else and why we're uniquely positioned to solve this problem, and how our product is better, has a moat, is, rivals the competition, et cetera. And then the how is coming last. So you've already explained why you're building this company and what your product does. And this is how you're going to scale it. So what's your go-to-market strategy, right? How are you building that sales and marketing team? What are your unique approaches to scaling this business? What does your business model look like? Investors will ask very often kind of, what type of contracts are you entering into? What's the timing of those contracts? What's the recurring revenue versus the services revenue or implementation revenue? So having that business model really crisp is super important. And then where do you go from here? So how do you scale? What's your financial projections looking like? How do you get from, $1 million in revenue this year to 3 million next year, or 5 million in 3 years, et cetera? They want to see what your vision for where your company grows is. And then lastly, but not least, obviously, is team. So especially on the earlier side, investors are investing in the team because company's still early. And so the people that will take it forward to meet these projections that you just shared with them is that team. And so building a strong team and a team that can really show that execution, that has a good background in building this type of company is really critical. So these are sort of what you want to make sure you have in your pitch deck. And then I want to spend a little time on, I think this is the hardest part, is knowing what financials investors are looking for and what metrics and KPIs. And I'll share that this is purely from a SaaS investor perspective, but many investors will also look for something similar regardless of the type of business that you're building. So obviously we want to understand your cash. So how much are you burning? How much do you have on hand? What's the cash basis of this company? And then I'd say where we spend the majority of the time is income statement. So this is really giving us a lifeline into how is this company operating on a month-to-month basis. So we're looking at your bookings, which is your new contracts that you've entered into. We're looking at your ARR, which is this recurring revenue of, how many you sign a contract, that contract's annual, that contract will renew next year, or is a 3-year contract and it's this much for the first year. And that ARR is something that's really important to SaaS investors. And I have a little more detail on the next slide on that. And then it's, especially when you have different product lines, it's so important to make sure that you're able to convey to investors that you have a good sense of exactly what the revenue is from these products, because it shows that you're also able to understand how do you grow with each of these products, what the COGS are. So software investors particularly, we need to see those high margins, and understanding the margins of a business is so important to investors because we want to see the high margins, because that just means that you have more room to sell and to grow and to scale. And so that's why those COGS are super important, and that gross margin by product is really important. And then obviously we need to understand, what's your investment into R&D looking like? Does it taper over time? Does it grow over time? What's your view? How are you planning to invest in sales and marketing? And then G&A is all else. But then looking at kind of others, these are some metrics that investors are maybe doing calculations on the back end for themselves. But magic number, payback in months, and customer concentration, as well as LTV to CAC. These are all sales efficiency metrics that investors want to understand. Yes, you've invested in sales and marketing. How is that doing? How are you spending too much on sales and marketing and it's not reaping the results that you're looking for? Are you spending too little and therefore you really that's what your fundraising is for, to pump more cash into sales and marketing? So these are some metrics, and you can Google kind of what the calculations for them are, but they're really important for us to understand kind of that sales efficiency. And then gross and net churn and gross and net retention. This is to help investors understand how exactly are customers performing here. Are they renewing every year? Are they growing their contract with the company? And why? What's the reason? Are they, are a lot churning, but they're replacing it with new companies and new customers? I think these are all things that we like to dig into. We obviously like to see under 10% churn and net retention in the 120% plus, because that shows to us customers, this is sticky. Customers are staying on and buying more and more of the product, but they're also not going to a competitor, or they're not deciding that this is not an important investment for their own team. So these are some really important metrics that investors are always looking at. And then rule of 40 is just one to keep on the back of your mind, but this is something I think more for later stage companies. It's essentially, yes, you're spending a lot of cash, but is your growth meaning, if you add your growth and your cash burn, does that get you to over 40%? So will you grow over time? It gives us a way to understand, is there a pathway to profitability here? So this is another one that lots of investors are looking at. All right, and I think the next one is my last slide, so I will stop talking soon. So because we are software investors, I really wanted to do a little bit of an overview on ARR. This is primarily for software companies. I think it's also valuable for direct to consumer companies where they're more subscription based. So that's where this metric is more important. But we just want to understand what's recurring versus what's one time. And that's what your ARR number is. Your ARR number is that recurring, just really stable revenue that you're going to get year on year on year. And so typically when you're building out an ARR, MRR is just the monthly version of it, MRR model, you want to understand, here's what we started with, here's how much our customers grew their contracts from existing customers, here's how many reduced their contracts, here's all the new customers we added, here's all the customers we lost, and then that's what gets us to the ending MRR number. So you want to typically do this month by month, and then it gives you a really good view as to how the company is performing, sort of on a top line basis. But one thing we do see is companies are adding in other things into ARR. So we definitely would exclude any services revenue. Even if those services are recurring, it's still not what we call as high quality revenue. It's definitely, we always exclude it from ARR. And then we also exclude kind of one-time any implementation fees or any other non-software revenue. I'd also, there's lots of schools of thought, but I personally also exclude pilots, because unless you're able to show those pilots converting, then I would maybe include them. But pilots are a little bit tricky because they're not necessarily that annual contract. So you really want to keep your ARR or MRR, the monthly version, to annual contracts. So this is that they're going to renew. Otherwise, if you do include pilots, which can be a little bit more fickle, it can mess up your churn and your retention numbers. All right, so I believe that is my last slide. Apologies, I might have gone a little bit over what Erin wanted me to, but I hope that was helpful and gave a good overview of venture and the different types of funding and what to look out for out there and what investors are looking for.
No, absolutely, Anki. Thank you for sharing those valuable insights. Don't even worry about going over. I think that the information you gave was very well put and easy to understand. And I'm not an entrepreneur in that sense and going through this, but I was able to understand it, which is ideal, right? You want everyone to be able to absorb the information. So now we're going to open it up for a Q&A. We had some questions come through, so I'll start feeding those. For those of you that are in the audience, please make sure to change your thing to everyone, so that way we can see all of your questions come through. So for your view, you can have everyone or the panelists, make sure it's to everybody. One of the questions we had was from GMA. So her question is, do lead investors, follow-on investors, and strategic investors sign on to the same terms in the same round?
Yeah, so how rounds work is you have one round. So let's say it's your Series A, which is you've decided to raise, making up a number because I feel like round sizes have completely changed in the last 2 years. So let's say for your business, it means that you want to raise a $10 million or $20 million Series A, right? You and your lead investor agree to that term sheet, which says, okay, this will be a $20 million fundraise. It will be at a $50 million valuation. And this is what the liquidation preferences are. This is, here's all the other nuts and bolts. You sign that with your lead investor first. You agree to that. And then typically you share that with all other investors that you've been talking to. And they sign on. They don't sign on to the term sheet. They sign on to the final docs. So a term sheet is less like signed, but more agreed upon. And then once you get that term sheet, you start updating all of the legal documents. So this is your shareholder agreement, your purchase agreement, your articles of incorporation, everything, your right of first refusal, your board resolution, et cetera. There's all these legal documents that obviously I would recommend working with a lawyer on this, which most investors will ask you to. But there's all this set of documents that really lay out exactly what the company now looks like, because now you're changing the whole ownership structure of the company because you're adding more capital at a new price, et cetera. So then these follow-on and strategic investors, they sign on to those financing documents. They don't sign on to the term sheet. That's typically how it works. But they do look to see the term sheet because it gives them an insight into the core aspects of what those financing docs will include.
Very good. Thank you for that. Yeah. One of the questions I have is, what is the engagement cycle for Salesforce when you're interested in a solution or an idea?
Yeah, I mean, it depends. There's companies that we talk to for, since they're Series Seed, where they might be a little bit early for us, and we just build that relationship, see how we can be helpful along the way. And then once they're starting to look for, investors, we get re-engaged. And depending on, again, it's so bespoke to every company, but depending on how long it takes to find that lead investor, it could be anywhere from, a month to 6 months. So it really depends on the timing that the company has, or years sometimes. We're in conversations with companies that have decided we have enough cash runway. We don't need another round of venture funding. So we'll wait another year before we raise capital again.
Very good. Giselle had a few questions. So thank you, Giselle. One of them was, what is the minimum percentage of the deal that the lead takes?
Ooh, we're not a lead investor, so I can't, I'm sure there's lots of different schools of thought here. I mean, we typically see at least 20% is what I want to say. It's a pretty hefty amount. Sometimes you have co-leads as well. So they might split the round between the two of them. Sometimes the lead investor will take 100% of the round too. So it really depends on what that particular investor is looking for. And I think also, like, part of it is you pushing back on exactly how much do you want the lead investor to have. You start getting into kind of allocation discussion. So if there's other investors that you want to make sure to have on the cap table, because like I said, you want that well-rounded cap table, the lead investor might have to take a little bit less so that they can accommodate having these additional investors on the, entering the round.
And that makes sense. Each partnership's different, right? And depending on the investment. And Giselle had another question. So how do these metrics soften, if at all, for an impact business?
Yeah, it's a good one. So I think you have different, I had a slide actually on impact investing, but there's different types, just like there's different types of traditional venture investors, there's also different types of impact investors out there. So our fund, I can speak for myself and our team, but we don't soften our metrics, right? We're still looking for that high growth. We're still looking for something similar to what a traditional institutional fund would look at for terms of metrics. Then you have other funds that are more patient capital or more, I'd say like concessionary, and they're able to, like, their mandate is very different. They look at companies that have a longer runway to exit, right? That don't have that super high growth, which is traditional with investors or venture investors. So there's lots of different types of investors. Again, that's why those conversations of exactly what type of investor are you, what are you looking for, and making sure that those align is so critical to your own diligence on those investors.
No, absolutely. I liked that point you made about the different relationships and sort of deciding what kind of investment you want and who you want to work with, because that's a pretty long relationship, right?
Yeah.
And then Tejas wanted you to repeat what you said on the rule of 40, if you can, for us.
Yeah, so I definitely I would Google it versus just so you have it for your own edification. But this is really us understanding kind of how does this company get to profitability? Are they burning more than they're growing? In which case we'd have a lot of concerns, right? Because that just means your cash efficiency is not there. You're burning way too much cash, but like it's not really resulting in much growth. And so that's why we really like to look at that rule of 40 to make sure, okay, at least like if you net the two, they are growing above 40%. If you look at public companies, I'd say these are the ones where rule of 40 is really important. Because you see that they're typically around the 40 mark. Some are lower, some are higher, but 40 is like a benchmark.
Okay. And then when partnering with Salesforce Ventures, what do we have access to?
Yeah, great question. But it's such a bespoke model to each company, because each company is so different and has different needs. Typically, what we're working on is introducing our companies to advisors. We have like a whole host of experts in enterprise software and experts within lots of industries within Salesforce, and so those are some invaluable conversations to have. And then we're also again bespoke, but depending on the goals of the company, we're making introductions to our product teams, we're making introductions to customers at times. So really is a conversation between us and that company and what their goals are and how we can best support them. But those are just a couple quick ones.
All right. Does anybody else have any other questions in the audience? This is your time. You have her undivided attention. We'll give it another few seconds, see if anybody pops a question in there for you, Enki. So we'll sort of move on. We'll see if some questions come in, we can filter them in. But I'd love to know everybody's takeaways from today's event. So what's one action that you're going to take to build investor relationships with Salesforce Ventures, or even just a general takeaway from all the resources and information that Enki shared with us? I'd love to see some of that in the chat, just to see that you guys have been engaged today and you were able to get something out of it. I know my key takeaways. So again, I had shared with you that I loved you sort of talking about the different type of investors and making sure it's the right investor for you with the right kind of relationship. And also I loved how you mentioned grants. It is free money. I think people forget that, right? And so it's such a great avenue of investment for entrepreneurs to consider. So thank you for sharing that and touching base on and reminding our entrepreneurs that they have that option.
Grants are just also, like I said, like they're just the historical way of doing grants, where it was only for nonprofits, is definitely changing now. Like it's definitely changing in the last couple of years. So I definitely recommend checking it out.
Yeah, and there's so many different kinds, and everybody's offering them, right? So it looks like Sitlali, it looks like she asked a question. So do you have some data on the split of women and men founders supported by your fund?
Yeah, so I have the data only on the impact fund, because that's where I sit. And actually, it's fresh off the presses because we just published it yesterday in our impact report. But our fund is 68% women or underrepresented minorities in the US for founder, co-founder, or CEO.
Very good. Right. And it looks like Chaitra really took away the type of investors in the deep dive on ARR. And Giselle's very thankful. So she had some key takeaways about building that list of impact investors at family offices as well as VC. And Tejas says it's interesting to note the role pilot revenue plays in ARR. Very good. I'm glad that you guys are getting some really great information out of this. So I love it. And thank you for sharing with us and taking full advantage of this opportunity to learn from Salesforce. We have a few announcements and programs that I want to share with you guys. So first and foremost, I highly encourage you to request a warm introduction with 4 Salesforce Ventures investors on our Get Introduced platform. If you're not familiar with this tool, please check out the link provided in the chat to get in connected with Kpis. Last year, WIC created this amazing warm introduction solution to assist our community members with creating connections to industry leaders and advisors. And we've been very blessed to facilitate over 2,500 warm introductions in the last year. So please check it out. Kpis up there. She just made her profile, so we're very excited to promote that. And then next, we are Women in Cloud's launching our 3rd annual Empower Her Access campaign. This is a digital campaign. It's aimed at generating greater economic access for women in technology, and it's going to continue to focus on barriers facing women tech entrepreneurs and the opportunities and policy amendments required to drive equality for women in tech. So this year's campaign, of course, is going to include our Role Model Spotlight series. It's featuring women technology leaders, entrepreneurs, and allies on our WIC social media channels, digital network, and website. We're going to be featuring some videos as well as some photos with quotes about how these leaders are empowering others, or how are they creating Empower Her Access for women in tech? So how are they creating access for females? Part of that, we're bringing back our awards ceremony for entrepreneurs to recognize leaders, advisors, investors, and partners who have provided them with access throughout their journey. And some of those award categories, so we have our Digital Transformation Project of the Year, Supplier, Advisor, and Investor of the Year, and of course, Women in Technology Outstanding Leadership Award. 2 additional things that we're bringing this year. So we're going to have some really great roundtables at our Inspire event. That's going to be, the theme's going to be 51% policy research roundtables. And then we're also going to be having a warm introduction challenge, really trying to get people to utilize the Get Connected tool and create those connections for yourself via that solution. Last year's campaign, we reached over 1.4 million, and we featured spotlights of over 130 individuals and companies, which is really amazing. So we look forward to this year's campaign, and we hope you'll participate. Nominate those in your community for a spotlight and/or award. Nominations are now open, so please go out and check that out, and please nominate some people. Next, so for companies looking for to get more involved in Women in Cloud, we're launching our annual corporate pass this year. It's a really great opportunity for companies who want to create access for their employees and clients to not only join the WIC community, but attend our signature events. So sponsors will receive 5 event tickets per signature event. They'll also receive 5 additional annual access passes for designated employees to gain entrance to 20+ events. And of course, we're always trying to provide as much impactful content related to professional leadership development, along with there's networking and recruiting opportunities, while amplifying your brand as a community contributor and supporter. Next, so we're super thrilled to share with you our new program coming in June, WIC Lead. It's the next generation corporate ESG women's leadership program. It's designed to empower corporate women and entrepreneurs to ignite economic access in just 6 weeks. Participants are going to learn how to lead and influence digital transformation projects through cloud and AI technology, teaching them how to grow their executive presence. We're going to be helping them build a personal brand identity, and how to become an impactful public speaker. So how are you representing your company and yourself in the industry? And of course, community development strategies, giving them a powerful platform to accelerate as industry ESG influencers and purpose-driven leaders. This program includes a corporate ESG certification. So at the end of the 6 weeks, our participants will be certified in this information, and co-branding and marketing with Women in Cloud as well. Lastly, we hope you're going to join us on May 6th to hear about Microsoft's at the next Fortune 100 Lunch and Learn. We have a great lineup of leadership who's going to be participating in the panel, followed by networking roundtables. Please join us to learn more about Microsoft's current strategy in the AI, cloud, edge, and intelligent apps marketplaces, or learn about their partner investment fund, community partner development manager, and the Build for 20 campaign, and of course, how to partner with Microsoft and support your existing relationship with them if you do have that, or how to become a partner. So we'll be providing that registration link for you guys for next month's, and seats are limited, so I do recommend that you register right away. And on that note, thank you to everyone who joined us today to hear from Salesforce Ventures. Thank you, Enki, for dedicating time to this session and being a resource for our community. We really appreciate your time, and I know you aren't feeling well, so thanks for championing and coming out today. And I hope everyone has a great rest of their day. Happy Friday and have an awesome weekend.
Thank you, Erin. Thanks everyone for joining.